Will the 2026 crypto bull run explode far beyond anything we have seen before, or are investors sleepwalking into the most misunderstood setup of this decade? Right now, Raul Pal is making one of the boldest calls of his career. He argues that the most powerful macro trade on Earth has already begun. According to him, almost every asset you can name is being crushed by the same problem: currency debasement. Tech is falling behind, gold is standing still. The S&P barely keeps up with inflation, but one sector is breaking away: crypto. It has outpaced every major technology adoption curve in recorded history, pulled in exponential returns despite brutal drawdowns, and positioned itself as the only clear winner in a world drowning in debt. Raul believes this cycle has already changed in a way most investors have not noticed. The debt structure of the global economy has shifted, the timelines have stretched, and the 4-year rhythm that traders have relied on for decades may no longer apply. He says the entire system is pushing us toward a new financial era built on blockchain rails, forced by non-stop debasement and accelerated by artificial intelligence. In his view, this migration is not optional, it is structural, it is global, and it is already underway. In this video, we are going to break down Raul Pal's exact predictions, the debt-driven timing he believes will reshape the 2026 cycle, and why he thinks this transition will produce some of the strongest asymmetric opportunities of our lifetime. Let's start.
And then I realized when I put all assets together and looked at them, since 2012, there are only 2 assets that really outperformed. Technology, because every day is more digital than yesterday, or tomorrow is more digital than today. And that was doing about 18% a year in returns. So yes, it was compounding wealth. The S&P and gold and all of these things were basically in line with debasement, i.e. you weren't getting richer by owning them. And then there was crypto. And crypto was the fastest adoption of any technology the world had ever seen prior to AI. It was growing at twice the speed the internet grew at, and it was producing 145% returns over the same period per year, including 3 80% drawdowns. Mm-hmm. And so, okay, if everything's driven by one macro factor, we have this urgent pressing need in a highly indebted economy for new rails to operate within, then you only have 2 bets, which is the technology and crypto. And when you divide the NASDAQ by Bitcoin, it's down 99.97%. So you have the single most powerful macro trade of all time that offsets the debasement, that is an adoption of a technology for the new internet. And so I'm like, well, this, if there's any time to be all in, this is it.
Over the past decade, the market has revealed a pattern that many people still have not recognized. When you line up the performance of the major asset classes from 2012 onward, something becomes clear. Most investments that people trust for long-term growth have simply been treading water once you adjust for debasement. Gold looks stable, but that stability has not translated into real gains. Broad market indexes rise year after year, yet their growth mostly mirrors the weakening of the currency beneath them. The returns feel comforting until you compare them to what is actually happening to purchasing power. Only 2 areas consistently broke through that ceiling: technology and crypto. Both benefited from a world that becomes more digital each day. The difference between them, however, has been staggering. Technology delivered strong, steady compounding around 18% a year. Crypto delivered something almost unnatural. Adoption grew at a speed no other technology has matched. It expanded faster than the early internet and faster than the global rollout of mobile phones, and it kept doing this through intense volatility. Even with 3 separate crashes that wiped out more than 80% each time, annualized returns still reached levels that forced institutions to pay attention. That kind of performance is not random. It is what happens when a new network forms and grows globally at the same time. When you look at long-term charts comparing Bitcoin to the NASDAQ, the difference is overwhelming. The NASDAQ has been shrinking in comparison, which shows how aggressively money has flowed into this new digital structure. This context explains why Raul Pal views the current environment as one of the strongest macro setups in modern investing. Debt is rising, currencies are weakening, and digital networks are gaining momentum. The shift is already underway, and understanding why it is happening gives investors an edge that most people never get.
We also know that in crypto, we've always been operating at 4-year cycles. Do you think we will continue to do that, or is this the cycle where it's going to be different?
The question is what drives the 4-year cycle? It was for a long while, people in crypto thought it was to do with the Bitcoin halving that happens every 4 years. And therefore there's a supply shock. But each year now, the supply shock is less each time. So it can't be the dominant driver. But then when you look at all assets, they're all driven by a 4-year cycle. And that was the cycle of the rolling or refinancing of the debts. So then if the structure of the debts is most important, what could have changed? Well, back in 2021 and 22, interest rates fell to 0 again. So they extended the duration out by a year and got it to about 5 years. So if debt maturity and the refinancing of it is the dominant factor, then if they've moved out from 4 years to 5 years, the cycle should elongate. And that seems to be what is playing out by all the forward-looking indicators that we use. It says that the cycle doesn't finish until maybe this time next year. Mm-hmm. So that's a brave call, but it's a probabilistic analysis. And when people say, yeah, but the famous words of this time is different, I'm saying it's not different. It's just based on the debt. It always was. So if it's based on the debt, nothing's changed. The debt maturity has been extended to 5 years. End of story.
Traders built entire strategies around the idea that every 4 years a new wave begins, peaks, and resets. Many assume this timing came from the Bitcoin halving because it created a supply shock. That explanation worked for a while, but the effect of each halving has decreased over time. The supply reduction is still meaningful, yet it can no longer explain the full behavior of a market this large. Something else has been driving the cycle beneath the surface. When you zoom out and compare crypto to the broader economy, another pattern appears. Almost every major asset class has shown a rhythm tied to how global debt is structured, and refinanced debt does not stay dormant, it constantly rolls over. Interest rates, maturities, and refinancing windows create a repeating timeline, and for many years this timeline lined up closely with the 4-year cycles that crypto became famous for. It was never magic, it was mechanical. A large portion of the economy was synchronized by the same debt clock. Then the structure changed. In 2021 and 2022, interest rates fell so low that borrowers extended the duration of their debt by roughly 1 year. Instead of 4 years, the refinancing window moved closer to 5. That small shift altered the cycle. If debt rollover has always been the underlying driver, extending maturities naturally extends the market rhythm with it. It suggests that what many investors expect to happen in 2025 may actually unfold closer to 2026. This idea does not weaken the bullish case, it strengthens it. A longer cycle means more time for capital to accumulate, more time for institutional money to enter through regulated pathways such as ETFs, and more time for the technological adoption curve to climb. If the cycle has stretched, the upside may have stretched with it. Understanding this timing gives investors clarity at a moment when confusion is rising. And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in.
So my guess is somewhere by around 2030, 2032, we completely transition to this new world I call the economic singularity, where GDP growth goes weird because we've got infinite population growth. So that changes the whole formula. Productivity goes through the roof, but who captures it? Is it us as humans? Is it the machines? How does the system work? How does investing work when you've got AGI? I don't know any of these answers, but I know that they have to continue the debasement trade until that happens, until the trend rate of GDP picks up and they can lower debt to GDP. And so I think we've got until 2030, 2032, of this system operating. And what it's doing, it's causing a forced migration into the new system, which is blockchain. So we're by continuing to debase, the knowledge of what is happening is increasing. That is forcing the adoption of the new system. Because of how the new system works, the more people come onto the network, let's say Bitcoin, the more the number go up, the more people are rewarded by doing it, the more people move across. And that's the good thing to do as well. And I think the governments understand this. I mean, having spoken to the Department of Defense about this years ago, they're like, yeah, this makes total sense. Over time, we need to migrate people across, and then it gets rid of a lot of the fragilities of the economic system. So that's the trade. That's what's happening. It's a migration into a new world that's being forced by the debasement of currency that won't stop until the rise of the AI and the robots. And then after that, we have no fucking clue how it's going to work.
A major shift is unfolding beneath the global economy, and it is moving faster than most people realize. The world is heading toward a period where artificial intelligence, automation, and digital networks redefine how value flows. Raul Pal describes this coming phase as an economic singularity, a moment when traditional models for growth begin to break because population trends, productivity, and technology no longer behave the way they used to. The exact timing is uncertain, but the direction is clear. Productivity is rising through automation, global labor is expanding through AI, and the old financial structure is struggling to keep pace. Until that new system matures, governments are forced to continue the debasement trade. They must weaken currency to keep debt manageable, pushing more liquidity into the economy. That pressure does not fade, it compounds. As currencies lose strength, people naturally search for assets that can hold or grow value through the turbulence. Blockchain networks benefit the most from this environment because their design rewards adoption. When more people join a network like Bitcoin, the number tends to climb, and that climb reinforces more adoption. This feedback loop pulls users from the old system toward the new one. It is not a theory. It is visible in on-chain activity, global stablecoin usage, institutional filings for Bitcoin ETFs, and the rapid expansion of custody solutions that traditional banks are now building. The process looks gradual, but the underlying force is strong. Debasement makes the old system less reliable, and blockchain rails offer an alternative that scales without restrictions. Governments and institutions are aware of this shift. Many departments, research groups, and strategic units have spent years studying how digital networks can reduce fragility. The migration is not accidental, it is a response to pressure that cannot be ignored. For investors who recognize the trend early, this decade offers a window that may not appear again. A major part of the opportunity forming today comes from the global liquidity cycle. Investors often focus on headlines about rate cuts or inflation, but the deeper driver is the movement of global liquidity itself. Every time liquidity expands, assets that sit further out on the risk curve respond first. Crypto has repeatedly been the fastest responder, not because of hype, but because of its structure. It behaves like a high-velocity network tied directly to liquidity expansion. When liquidity rises, new capital needs a destination, and digital networks absorb that inflow with remarkable speed. Right now, multiple forces point toward rising liquidity over the next 18 to 24 months. The United States is running record deficits that require constant issuance, and international demand cannot keep up. That forces the system to rely more heavily on domestic liquidity creation, which supports asset prices even when the economy slows. At the same time, artificial intelligence has created an investment wave that requires enormous capital data centers, chips, energy upgrades, and infrastructure spending are pulling liquidity into the system through government incentives, corporate borrowing, and private capital. These flows do not shrink. They intensify as AI becomes more central to productivity. The connection to crypto becomes clear when you look at adoption curves. AI and blockchain thrive under the same macro conditions. Both benefit from cheap capital, rapid innovation, and global integration. When capital floods into AI, it lifts the entire technology sector and spills into digital assets because the market begins to price in an increasingly digital future. Bitcoin, Ethereum, and high-utility networks tend to outperform during these periods because they represent ownership in the rails that future value will move on. This environment sets the stage for a powerful run as we move deeper into the second half of the decade. When liquidity expands while adoption accelerates, upside becomes more explosive than most investors expect. One of the strongest forces shaping the next phase of the market is the quiet accumulation happening behind the scenes. Retail investors often react to price moves, but institutions build positions long before those moves appear on the chart. The past year revealed a clear pattern. Large custodians expanded their digital asset divisions, major asset managers pushed multiple Bitcoin ETFs into the market, and traditional banks began offering direct access to digital assets for high net worth clients. These actions signal a shift in posture. Institutions are preparing for a world where blockchain assets become standard holdings rather than speculative bets. This shift matters because it distorts supply. Bitcoin has a fixed issuance schedule, and Ethereum experiences supply compression during active network periods. Every time institutions take coins off the market, available supply shrinks. Recent on-chain data shows long-term holder supply near all-time highs while exchange balances continue to drop. These conditions often precede strong uptrends because fewer coins are available for market participants who decide to enter later. The introduction of regulated ETFs added a new dynamic. These vehicles offer a simple path for large pools of capital, especially retirement funds, to gain exposure without technical barriers. Even small allocation percentages can create massive inflows when applied across pension funds, wealth managers, and insurance companies. The potential pool is measured in trillions. Bitcoin ETF flows already reflect this, and similar demand patterns are likely to appear if Ethereum and other major networks receive full regulatory approval. The broader narrative is shifting towards scarcity. Digital assets are becoming part of long-term strategies, not short-term trades. When demand rises while supply becomes increasingly constrained, the market tends to move with strength and momentum. Investors who recognize this structure early position themselves ahead of the wave that often catches others by surprise. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.